Yo, what's happening? 14th of March, Tuesday's video got some engagement, which is what I want. Just people to, banter it out, talk about it. My opinions are my opinions, yours are yours, but that's how we all come to some sort of consensus and conclusion. Toss some opinions around, hear what a person has to say. Didn't look like any name calling going on. It's just a few comments, but hey, comments. That's what we want, some engagement. So thank you guys for watching. Thank you for engaging. Thank you for throwing some sort of thoughts in. That's all we ever want, just to hear what another person thinks about something. It's when we get those thoughts going that people come to conclusions. So this week, there's a Wall Street Journal article that came out a couple weeks ago about, see here, it was Biden's relief program causes really a subprime crisis, if you will. So what it was, we had government capital or public capital, taxpayer money that's going to help offset people's payments on their mortgages. Well, as a result of that, they said that 14% of FHA-backed mortgages are in default. That's over 1 million people in default because there's over 7 million FHA mortgages out there. So, 14% of them, they're right now in default and they're using public capital to maintain their payments. Now, there comes a point where it can only go so far. And the Wall Street Journal is saying, hey, we're calling for this to be ended. Well, if that ends, then what, right? Now you got foreclosures. You end up with a foreclosure situation. Now you end up with what we were dealing with in 2008. Start having all those foreclosures. Now that starts to affect the housing prices, right? Possibly bringing them down if there's enough of them. But what happens to the people that own the houses? That's what we know about 2008. So if you're in the real estate investment world and you're investing in real estate and you bought those houses at below market value, a lot of times you had a built-in renter because those people need to go somewhere, or is the neighbor down the street who lost their house. So ultimately, we're just creating a bigger rental pool. So it may impact the house values because you have more people going to foreclosure, more people that cannot afford to buy the houses. Therefore, there's not as many in the market, supply and demand. There's not as big a demand as far as the purchase side. Real estate investors come in and look what you do. You benefit. Now, does that mean you sit here and you wait? Oh, let's see if this happens. It might not happen. Like you said, it's been propped up. So if it doesn't happen, you want to always be ready. Be out there looking for those deals. Be out there looking for houses you can reasonably keep rented for the entire time you own it. You can raise rents on it and it can appreciate. You don't need to be able to raise that much. 3% per year on the rent raise is going to be a significant growth for you. If you don't understand the numbers, we can talk. If you're getting someplace you can just guarantee a 2.5% appreciation, you're kicking ass. That on a 20% down will get you somewhere in the range of about a 10% return on your investment. 10 to 13%, depending upon how much you have in costs. Now, we're getting some pretty aggressive things out there in various areas. You want to reach out to me if you want to see which markets have some significant ability to get you in there with a phenomenal just deal, period. Especially with the new DSCR we have. If you haven't listened to me on that one, debt service coverage ratio, you're not bringing out any paperwork on your personal income, no tax returns, no pay stubs, no W-2s, no K-1s, none of that crap, no 1099s, no explanations on your income, just looking at your assets, your credit, and does that property cash flow. It doesn't have to cost you much. It can basically rent for exactly what you're paying for it. That's it. And if that happens, you can get that house and you can get it with your LLC for 30 years fixed. That kicks ass. And there's I would say the majority of the time when we're pricing that deal out, the interest rate for the DSCR program to your LLC, we'll talk about that too in great detail, has a better interest rate than if you bought it with a Fannie Freddie loan. And it doesn't go on your credit and it does not impact your Fannie Freddie loans later. So I wouldn't say it's the holy grail, but it's its first cousin. That's just my opinion. Now let's get into the markets. Actually, no, I got to show you something else. Let's go and do this share screen right here. I was talking about the Wall Street Journal. I was reading some of that earlier today. And I was also in Yahoo Finance. But I'm going to show you this, aaronchapman.com. That's up and running. So it's not perfect yet. We're still building it. We're still working on it. It's still something that's going to get done, but I am still waiting. It looks like it's working. Yep, we got it working. And so part of this isn't working. There's some yep, there it is. So that's kicking on right there. Just got to have me in there, right? A little bit of mobile action. And if you want to schedule a consultation, you click right there. I'll take you right to my CCM site. Right here, schedule a consultation, take you to my CCM site. You want to start a loan application? Click it there. It'll take you to my CCM site. So you can start an application. It's compliant, equal housing lender, all the stuff that you need to have to make sure that I can do this legally. There's other information we're going to have in here for others that I believe would be great to have in your group, I guess, in your business, other trusted people to have in your business, if you will. So keep cruising down here. We're going to have, actually, here's what I want you to be able to take a look at. Where is it at? Okay, let me see here. I'm still learning this myself. Oh, right here. Talk to you about the book. It's coming out here real soon. Red Economics. That is what this one is looking like. My brother is the artist that painted that. He painted every single picture for every single chapter, and then a lot of art within the chapter. We got over 2.5 years of art going on here. This is just examples of that. Of course, this is chapter one. I believe this is chapter three. This one's later on, and this has all the guys. Actually, this is chapter three, this is chapter two. The guys that I spend time with, I go hunting with. There's a reference in here. So you may even know some of these guys. And I have a quote from each chapter, and then you can read the forward. The forward by Robert Allen, the guy who's the OG of investment real estate. Look him up. The guy wrote No Money Down in the 80s, a real New York Times bestseller, not some jerk off that got all his buddies to buy at the same time. So that's that. So let's get into the markets. What do we got going on here? Okay, here we go. Mortgage-backed securities. Now we've seen where we have the news was going on and on and on about the interest rates went down. We just a sharp drop. Guys, it wasn't a sharp drop. It was a small drop. It was small enough that maybe move the cost by 0.3%. And how do we know this? Let's take a look here. So we've got the majority of this. We had one day where it was higher than most, but then it literally sharply turned. We had to open up on one morning. This happened to be on the 4th of this month, and it rocketed up and it hit the same barrier we keep talking about. The barrier that was established the day they announced quantitative easing. Pulled off of that, and it's continued to keep riding down. Now, there's a lot of talk right now that with the stock market taking the beating, and that is some strategic way to get interest rates to come down. Beat the hell out of the stock market, force the money over into bonds. But there's so many other places to put capital. It doesn't always have to go to the bonds. The bonds, in my opinion, have reached their total value to the marketplace when they reach this. That is the peak value is in this block right here. Anywhere from here to here is peak value as we've established. Take a look at this. This goes back since we had quantitative easing ended to where we had what was called quantitative tightening back in 2021. It fell all the way to where there was a value in the security for outside money start coming in. And look, it keeps hitting this block and coming back down. Hits the block, comes down, hits the block, comes down. That is the value that the market is willing to place on mortgage-backed securities. That's where I believe the interest rates will not go any lower than they were back in the mid-September of this last year. We saw that time back in January of 2023, mid-September. These are the areas that we're watching for our best interest rates period. I think we've seen the best rates we're going to see for a while, unless an enormous amount of money leaves the stock market and goes here. Now, that is at least some speculation people have. But the administration right now is interesting speculation that I'd read that the administration right now is trying to mess with the markets enough to get everybody to sell out of stocks, crash that market, put into bonds, drop interest rates, eliminate the national debt. I don't know. I'm not in the back rooms listening to how that's getting done, but we're not seeing that money flood to the bonds. Why? Because they're already at their peak value. That's my opinion. Now, I'm just looking at charts and price action. There's a lot of other people have different opinions, but those opinions have not been right. That particular price point has been right multiple times. So that's all I can tell you. We're still at a very good position. If you're waiting for them to go down further, I think you're going to be waiting for a very long time. That's just what I think. If you have any questions about that, put some comments in, reach out to me. We'll talk about it. I'll give you my thoughts. I'll take you all the way back to 2008 and before, because I've been studying this since 2001. Been at this for 24 years, guys. I'm not a person who's just getting this figured out. I've been doing this a very long time. Talk to you guys very soon.